Welcome to Investors Insights. Our topic today, debt and earnings on the rise. You heard me right, and we've got great information for you today. I'm joined by my distinguished colleagues who I thoroughly enjoy working with and brainstorming and coming out of these portfolio strategies meetings. Trey Booth, Bobby Norman, Ty Miller. Gentlemen, really enjoyed our morning session. Really appreciate all the time and effort you guys do in putting this research together. And I can't thank you enough. With that said, debt and earnings on the rise. Trey, you had our full attention talking about GDP and debt. So if you don't mind, start us off here and we'll go from there and see if we can find some earnings in the process.
Yeah, absolutely. What wasn't a widely covered data point last week was fourth quarter GDP, and that makes sense because that's the announcement of how much goods and services were produced by the U.S. economy, the GDP, gross domestic product, in the fourth quarter of 2023. Well, we just finished up the first quarter of 2024, but that amount of data takes a long time to finalize, and so it's very much what we call a lagging indicator, and that it covers what happened deep in the past. But to us, it's important because it really is a good snapshot of what's happening in the U.S. economy. And it was a good report. The fourth quarter, the U.S. economy grew at 3.4%. That's a really strong, anything above 3 is typically a very strong number, and beat expectations of 3.2. But when we see a report like that, we like to look under the hood and see, what kind of drove that. And I'm pulling up a chart here, and what it shows in the bottom line there is the GDP, the gross domestic product over the last year. And then the blue line is U.S. personal debt. That's individuals' debt, credit cards, car loans, house debt. That's in the blue line. And then the orange is public debt, the governmental debt. And what concerned us is that while GDP went up, our debt went up by even more. And so we're financing this growth with higher and higher debt, which over the last 15 or so years hasn't been a problem until recently when interest costs are spiking. And so we're increasing our leverage at a time when the cost of debt is going up. And so that really maybe compounds the potential issue with financing it. So the last $1.5 trillion in GDP growth came with over $2.5 trillion of new debt. And so that's kind of a ratio that potentially is unsustainable. But in the meantime, that's a good sugar high. And so something that we're watching closely, because this bleeds into profits, it bleeds into corporate America, it bleeds into markets in terms of growth is great, but how are you getting it? Is it natural growth by innovation, or is it growth by borrowing? And in a higher interest rate environment, that growth by borrowing is somewhat concerning to us. It's something we're watching very closely.
Yeah, we're going to keep our eye on it, and it's been a discussion with our clients with interest rates higher, the national debt, corporate debt, individuals' debt. I thought you gave a great explanation this morning in our meeting, and I appreciate you bringing that to our attention, Trey. And Bobby, though, you turned around and said, but wait, let's look at corporate earnings. Corporate earnings are going in the right direction. And last time I checked, corporate earnings help drive the stock market, stock valuations. So elaborate on that.
Yeah, with the market and equity valuations at higher levels, it's important that we look at what is going to keep the market at current levels or higher. And in our opinion, corporate earnings will be a key driver. And so looking at this chart that shows the estimated quarterly earnings per share of the S&P 500 that you can see in the blue columns, also the mid-cap companies in the orange columns, and the small-cap companies in the yellow columns, it shows us that the longer-term outlook is favorable for corporate earnings to continue to signal strength in the market. So we believe that corporate earnings drive the direction of stock prices over time, especially when the major indices are trading at these higher valuations. So as the data shows, earnings per share are expected to trend higher across each of these indices over the next several quarters, with full-year estimates potentially, and I say potentially, reaching record highs for each index in 2025. But as always, these are estimates, and that could change. But that said, we trust that today's chart provides a unique perspective on what we view as a major catalyst for future strength in the markets, and that is stronger corporate earnings going forward.
Earnings drive stock prices. There is no doubt about that. And so it's very important to keep our eye on that. And then also just to emphasize how we drill down on a lot of data And we look broad-based as well as drill down to look at specific things. Those of you who have watched our blog, you've heard me use the word over and over again, navigate, maneuver through this data to make sure that as we make moves in the portfolio in relation to financial blueprints, there's a lot of research that goes into this in a variety of ways. And Ty, you brought up some good information today. I know you were talking about operating margins, but also you got into insider buying and selling, and I was totally fascinated by your data. So share that with our viewers.
Yeah. So as Bobby alluded to, earnings drive, can drive stock prices. Well, operating margins can drive earnings. And so operating margins are at their highest level since 2008, aside from the COVID pandemic, the COVID pandemic recovery. So as you imagine, operating margins really expanded after we were shut down for COVID and reopened. But now we're at the highest level since 2008, which is, really a good sign for earnings and for stocks in general. Where we could get in trouble is we're at such a high level. If this were to drastically come down, as you see in this chart, 08, 09, 19, 20 kind of time frame there. It's really when they fall off a cliff that you get these kind of recessionary moments. We have seen no sign of that so far, but just something to monitor. Right now, it looks like everything is really strong, and something that we're going to keep an eye on moving forward in case that were to change. Some other interesting things that I found that won't necessarily tell a lot about the direction of the movement, because we're kind of lukewarm on both, but insider selling and buying. So the S&P, the inside sales are the highest since early 2022. People can sell for a number of different reasons. They may need the cash to finance a home. They may need the cash. They think there's different ways to deploy that. Or they could think that their stock is a little overvalued. We do see insider selling usually pick up after strong market runs like we've seen. So this isn't a surprise, but we're not at extreme levels by any means. And at the same time, insider buying is actually increasing as well. And so, that's something to be really bullish about. As I mentioned, sellers can sell for different reasons. Buyers are only buying because they think their stock is going higher. And so with insider buying kind of increasing, that's something, very fascinating. I would like to point out on this chart that they never really seem to miss an opportunity. 08, 09, you can see this elevated level, and especially in the pandemic. So usually when we get to some kind of extreme levels or increasing buying, that's usually a pretty good sign that the market is bottomed.
Yeah, and the emphasis I want to put there, that's the kind of data we're looking at. But number two, and really very important, is that we will shift according to, as this data starts to become more and more evident, that we need to make moves in the portfolios. So those of you that have been long-term clients, and I was reminiscing the other day, I've had clients since my early 20s. That we will make moves to get more conservative, or if we need to start to move more, and I don't want to use the word aggressive, but to reach in relation to your financial blueprint to get more towards equity exposure and those kind of things, we will do that. So this is the kind of data we look at. We are always available to discuss it with you one-on-one, whether on the phone, whether through Zoom, WebEx, in person. We thoroughly enjoy. And in addition to that, we're going to continue to give you data through these vlogs, through our social media, Facebook, Twitter, LinkedIn, YouTube, our podcast. The list goes on, as we are frustrated educators and we believe knowledge is power. We want you to have a great week. Keep in mind, we didn't pull an April Fool's joke today. We're serious about this, and all is well. And we will keep you updated through the whole month of April. And we thank you for believing in us, and know that every day we strive to make our clients' lives better, richer, fuller. Have a great week.